So, imagine you've been dreaming of buying your first home. You've saved up a little bit for a down payment, but there's still a huge gap between what you have and the full price of that dream house. That's where leverage comes in. It's like borrowing the difference from a bank or financial institution. Here's how it works. Instead of putting down 20% to buy a $100,000 house, with leverage, you might only need to put down 5%. So, if you borrow the other 95%, you can control that expensive house with just a fraction of its value. Sounds pretty tempting, right? That's why so many people are drawn to leverage. It promises to stretch your finances and make big investments feel more within reach. All right, let's dive into how leverage works. Imagine you want to buy a house, but you don't have enough cash on hand. So instead of paying the full price up front, you put down a smaller deposit and get a mortgage from the bank to make up the difference. That's exactly what happens in trading with leverage. When you trade with leverage, it's like buying that house. You're only putting down part of the money, what we call margin, and your broker loans you the rest. For example, if you want to buy $10,000 worth of a stock but only have $2,000 in your account, your broker might let you borrow the other $8,000. This means for every dollar you invest, you control $5 or more. Now here's where things get exciting and a bit tricky. If the market moves in your favor and the stock price goes up, your gains are magnified because you're controlling much more than what you originally invested. So if that $10,000 stock increases by 20%, your original $2,000 investment could turn into $4,000. On the flip side, if the market moves against you and the price drops by 20%, those big gains become big losses. In this case, your $2,000 could be wiped out in a hurry. So remember, leverage is like that house purchase. It can help you achieve bigger gains, but also comes with the risk of larger losses. And because everything gets magnified when you use leverage, every percentage point change in the market has a much greater impact on your account than you might think. Okay, so we've seen how leverage works, how a small amount of money can control a much larger position. Now, let's dive into the magnification effect. Let's stick with our simple example, where you invest $1,000 and use 5:1 leverage. Imagine you're playing a game where the deck is stacked in your favor. You start with just $1,000, but the broker lends you an extra $4,000. So now you have control over $5,000 worth of assets. That's pretty impressive, right? And here's the surprising part. The magnification effect really comes into play when the market moves. Let's say the value of your asset goes up by just 2%. With that leverage, your investment would actually triple in value. That's like going from $1,000 to $3,000, a huge gain. But you know what? It works both ways. If the value of that same asset drops by 2%, not only do you lose more than just your initial $1,000, but it's actually tripled. So instead of losing maybe $200, you could be looking at a loss of over $3,000. So remember, leverage is like having a superpower in the stock market or crypto. Great when things go well, but devastatingly dangerous if they don't. And here's the surprising part. While leverage can amplify gains, it also amplifies losses. Imagine you're buying a house with just $10,000 down payment and borrowing the rest from the bank. If the value of your house doubles, you make a huge profit. Your initial investment is now worth 4 times as much. But if the market tanks and the house loses half its value, not only do you lose all that extra profit, but you could end up owing the bank more than it's worth. Let me give you an even simpler example. Think of leverage like a seesaw in a playground. If you sit at one end, you can barely move it. But if your friend sits on the other end and leverages their weight by using a few small rocks as weights, suddenly that tiny bit of added weight makes the seesaw tip wildly back and forth. That's how leverage works in markets. Just a little extra capital can make big moves. But here's where things get tricky. If the market doesn't move in your favor, not only do you lose money, but your broker might force you to close your position, a margin call, even if you don't want to. Imagine you're on that seesaw, and suddenly your friend's rocks roll off. There goes the balance. In markets, this is like your broker saying, hey, we need those rocks back. If you can't provide them, they might forcibly push you off the seesaw. This doesn't just mean losing money. It means losing everything. And that's why leverage is so dangerous. It takes a small mistake or an unexpected market move to turn what was supposed to be a smart investment into a disaster. So next time someone tells you leverage is only good, remember, In markets, leverage can amplify both gains and losses. Sometimes, the losses can be catastrophic. So, we've seen how leverage can massively boost your potential winnings. But here's the catch, and why it's so risky. It's like playing a game where you can double your winnings, but also lose everything in one roll. Imagine you're at a casino table with a simple dice game. If you bet $10 and roll doubles, you get to keep your $10 and win another $10. So now you have $20. But if you roll snake eyes once, you lose it all. This is similar to how leverage works in the markets. Let's say you have $10,000 in a stock that's trading at $50 per share. Without leverage, you can buy 200 shares because frac 10,050 equals 200 backslash. But with 10x leverage, you could effectively buy 2,000 shares because the market is borrowing money for that extra 900%. If the stock price rises to $60, your investment seems like a winner 2,000 times 60 to 50 equals $20,000 making a huge profit. But what if it drops to $40? Now you've lost 2,000 times 40 to 50 equals $20,000 and you lose your initial $10,000 too. And here's the surprising part. In many cases, leverage can force you to close your position if it goes against you. So, not only could you end up with nothing, but the market might even take away that initial money you put in as a deposit. That's why people say, leverage is a double-edged sword. The truth is, leverage turns the market into a high-stakes casino, making it easy to go from winning big to losing everything. It's like being handed a massive lottery ticket. You might hit the jackpot, but you could just as easily get burned. So, leverage is not about getting rich quick, but about magnifying risks. Let's dive into why this matters and what you should really be focusing on. First off, many people believe that leverage is a magic wand. Wave it, and suddenly you can control more of the market than you could afford with your own money. That's a misconception. Leverage amplifies both gains and losses. It's like setting up a seesaw where even small movements at one end have massive impacts on the other. And here's the surprising part. Instead of focusing on how much you can borrow, which is what many people get caught up in, you should focus on managing your risk and understanding the true cost of borrowing. Here's why. Imagine you're a pilot flying a small plane. With no leverage or borrowed money, your safety margin for error is like having full control over your altitude and speed. But with leverage, it's more like trying to fly that same plane while wearing a pair of boxing gloves. Your movements are restricted, and every mistake feels amplified. The real risk in leverage isn't about how much you can borrow, but about how much volatility the market might throw at you. If you're not prepared for those swings, leverage can make your financial situation go from manageable to a disaster quickly. So what's the lesson here? Use leverage wisely or avoid it altogether. Remember, every time you decide to borrow money in the markets, you're essentially betting on a very narrow outcome. Sometimes that bet pays off, but often it doesn't, and that can lead to significant losses. By focusing on managing risk and understanding the true cost of borrowing, whether in the market or in your personal finances, you'll be better equipped to navigate those risky waters without getting swamped by them.